Well, hello everyone. Today's webinar, we are going to talk about, did you inherited an IRA? Yeah, the rules can be really complicated, and that's why we decided today to bring you this particular webinar. We are just going to be discussing, it's going to be a short webinar. We are going to try to give you the key rules here for you to know if you inherited an IRA, what you should do, what are good strategies out there, and all that. Just for compliance reasons, I have to tell you, like, all the information that we are going to share is going to be only for educational purpose only. This is not investment advice, not tax advice. You always have to look for your professional. I'm just giving you some information that can be helpful for you in the future. So after that, let me say that, well, for those that don't know me, my name is Alonso. I'm a certified financial planner. I've been in the industry for the last 27 years, and well, Investopedia named me between the top 100 financial advisors, also ETF.com, and well, recently Go Bank and Rate named me between the 100 top money experts in the US. So I love what I do all the days, and I just want to share some knowledge with you that I think it could be helpful in case you are one of those, beneficiaries of an IRA account. So many things have been changing lately, and yeah, inheritance IRA can be complicated and is a combination between a complex financial process and also an emotional process, because it's the loss of someone that you really love or who really care for you. So is sometimes my clients feel like that's their money, but it's not their money because they feel like it was their parents' money or something like that. So it's going to be kind of hard to take rational financial decisions with this money, and taking into consideration so many rules out there, and that it can feel sometimes people are willing to just not to think about it and just to leave it like that. So we will show you why in this webinar that will not be the best strategy for you. And please, if you have any questions, please let us know. We will be trying to be aware of any questions that you may have, and we will maybe answer them as soon as we see them or at the end of the webinar. We will have some time for that also. So the first thing, I know it's a really hard process, but try not to leave everything try not to forget about that account. Try not to just say, okay, I don't want to see that money. Let me think in the future when I'm going to do that. But I know you will be in this process. You will have your time. I'm not telling you to rush anything. But yes, the IRS sometimes wants their money. So it's going to be really important that you take this into consideration. We are talking mainly about those IRA accounts. Those accounts that you inherited. And as you know, in those traditional IRA accounts, the owner, the original owner of the account has been saving all these years, having this money tax deferred, and the IRS wants their money. And that's what it makes it a little bit more complicated, because now you inherited that account and now you're the responsible for those taxes for the future. Of course, you're going to be receiving a lot of money, but also you will have to pay some taxes there. So why this is so important now? I see that maybe sometimes we don't know what the 10-year rule is, or sometimes we feel that it's something really complicated. Oh, the 10-year rule is something that is really important for you, for what we were discussing all this time. It's not a new rule out there, but I feel that maybe it was some time that people were just like getting used to the rule, because it was, it came in 2019 with the Secure Act, and it was effective in 2020. So we can say that it almost have like 5 years out there. But I would say that the most important change of this rule was like before. You can do something that was like a stretch your withdrawal from this account on your own pace. You will say, I received this IRA, but I don't want to think about that. I just want to leave it there. And maybe sometimes I will start to withdrawing that money in the way that I want. That will be okay if you were the spousal of the original owner of the account, but will not that be that okay if you were not the spousal, you were another beneficiary, and we are going to discuss about that. Why it will not be that okay? Because the new rule says that if you're not the spousal beneficiary, and you're someone else, like the daughter, the son, whatever, anyone else, now you have a 10-year period to fully distribute, to take all the money from that account. So we are going to discuss about why now you just cannot forget it there, because if not, you're going to have some huge tax implications. In this webinar, we are not going to, there are a lot of rules, a lot of things to talk, but maybe if you're wondering, this webinar, we are just going to talk about designated beneficiaries. A designated beneficiary can be the wife, the kids, or those that are designated in the IRA account. We are not going to be talking about in this webinar about charities or money that was just left to the state and things like that. So yes, a designated beneficiary will be as easy as the name sounds. It will be someone that is designated as a beneficiary in the IRA account. So, okay, now that you know, there is something that is called the 10-year rule. What this rule is telling you, you cannot just leave it and forget it, because if you do, you're going to have to pay a huge tax bill, because the money is going to keep growing and compounding there. And then if you just forget it and you don't want to see it, maybe this can take you to a higher and higher tax bracket, because remember, it's an IRA account. The taxes are deferred for the future. So now when you withdraw that money is going to come as income to you. And it's going to be as a huge income. It's not the same, I don't know, you have $100 and take 10, 10, 10 all the years, than taking just 100 as a lump sum, and that can push you to a higher tax bracket and pay way more taxes on that. So now we have this 10-year rule to take all the money out if you're not the spouse. Okay, we're going to keep checking a lot of things about this one here. So now that you know about the 10-year rule, we previously said this does not apply to the spousal beneficiaries. What is your key advantage? You have the most flexibility. It's like that. This rule will never exist for you. So what does that mean? Well, it means that you have like two different options. The first one, you can just say, well, I don't know, your husband, your wife, your couple just passed away, and you just want to roll over that money into your own IRA. That could be a great strategy, because you're delaying those required minimum distributions that, as you know, you're going to have more time, in case, depending on your age, to keep that money growing there and compounding for you. Let's say it just like this. I don't know, we have a couple, maybe the husband is 70 years old, or maybe 69 or something like that, and the wife is 40. Just we can switch it, but I'm just going to use this example. Maybe the husband passed away, he was 69, and now you can roll over those money. You can transfer that money into your own IRA. And now that money can keep compounding there, and maybe you're going to have to withdraw that money when your RMDs kick in. Your required minimum distribution is when the IRS is telling you it's time to withdraw that money. It cannot keep growing tax deferred forever. So now you start withdrawing that money, and it's going to come as income to you. But as you can see, you have that money growing since you were 40 for all those years, maybe until you're 75. Okay. Then second option could be, maybe you already have your 401k account, your IRA account is growing well there, but maybe you need some money now. So you can just treat it as an inherited IRA and start your stretching. Start withdrawing that money. That money is going to come as income, but you don't have to go for any penalty on that one. And if you're under 59 and a half, you're not going to have to pay those 10% in penalty there, which is a great scenario for you. But remember something that is really important. I'm going to go back to my same example. In my example, the husband, could be the wife, but I'm using the husband here. The husband was 69 years old. But let's change the scenario. maybe he's 72 or 73 years old, and he was already taking some required minimum distributions because it was the time the IRS wanted his money. So he was already collecting some money from that IRA account and paying taxes because that money comes as income, as we know. So in this case, you are not going to be able to stop the RMDs. Once the RMDs starts, you cannot stop them. You can stretch them. And now you can use your own, life table that is maybe will be longer because you're 40 in this example that I was giving you. You can use your own life table there. So it means like you're going to use your table for more years to withdraw that money, but you cannot stop those RMDs, okay? This is really important. Remember, once the RMDs starts, you cannot stop them. So in the spousal, as we can see here with these rules, it is really flexible. It's like the rules, these new rules never existed. So it's quite straightforward there. But in most of the cases, what we see is like the ones that are having these issues are the non-spousal beneficiaries. Well, in this case, yeah, you cannot roll that IRA that you inherited into your own IRA. Be careful with that. That is something that you cannot do. In this case, yeah, you must fully distribute. You must fully take all the money out from that account within 10 years. So in the year, after those 10 years, you are not going to be able to have not just one penny in that account, okay? Sometimes people ask me, what about if there are some exceptions to this rule? Yes, there are. If you're a minor children of the deceased, you're not going to have to go like this. The spousal rules are the ones that are going to apply to you until you reach the age of majority, okay? If you're a disabled or chronically ill individuals, you also go for the spousal, rules. And individuals that are not more than 10 years younger than the deceased, okay? So as you can see, the rules of the exceptions are not for everyone. So most of the cases will be something like, on average, the cases will be, it was a couple, they have some kids, now maybe that couple is 60 or 70 or whatever, and now they pass away and the kids are receiving that money. So they are not minors, maybe they are not disabled and things like that. So in your case, if that is your case, yes, you have to withdraw all the money there. Be careful with this one. If your parents, when they pass away, they were already taking RMDs, you cannot stop those RMDs. The rules applies the same. Once those RMDs start, you cannot stop them. Okay, be careful with that. So now we know the spousals have some rules, like it will say like the most flexible ones, and the non-spousal beneficiaries have other rules that we have seen here. Here we can see it. So how you can keep, now that you know these rules, and you're one of those non-spousal beneficiaries, and you're asking me, okay, what should I be doing? Should I be taking all the money at once? Should I be stretching all the money? What should I be doing here? As we were talking before, each case is different. It depends on the amount that you're receiving, but sometimes in most of the cases, receiving just a lump sum at once can take you to a higher tax bill that maybe that's not what you're looking for. So be careful with that. If you can spread those distribution in time, it could be better. Remember that money, please keep the money invested. We're going to talk about that. But if that money is invested, maybe it will be growing in the years, many years, because you have 10 years with the money there. So maybe what you want to do is like, oh, don't wait until the last time. Because if not, what is going to happen is like when you withdraw all that money, Uncle Sam is going to be receiving more money and he's not asking you for that. And in the other case, if you just want to just go and say, oh, maybe in this year, my tax brackets are lower because maybe you're about to retire. Maybe you just said, oh, I can use these tax years because maybe you don't need it to go there. That would be a nice solution. Also, you don't have to take this exactly same amount all the years. Just for example, maybe you're currently working for 1 or 2 years, but you know that you're going to retire in maybe just 1 or 2 more years there. And now you know that in 2 years, your tax bracket is going to be way lower. Maybe what you can do is like, don't take it like, this is not the case with RMDs, but maybe you're not taking, the owners of the account was not taking RMDs, and now you just wait for those 2 years, and then you start collecting money after those years, because now you know that you're going to be in a lower tax bracket, and you can play with those, filling those lower tax bracket there. Or maybe it's the opposite, as you know, like maybe you're in a sabbatical year and you decide this is a good year to take more money in this year. Yes, play with those distributions. It doesn't have to be this exactly same amount. Something also to take into consideration, always 11 in this case will be better than 10. We were talking about the 10-year rule, but remember, the year number 1 start after 1 year of the death of the original account owner. So that means, like, if you, someone passed away in November, and then you decided that you want to take some money in that November of that same year that he passed away, you will have 11 years, because this will be like year 0, and your first year is going to start next year. So it will be better to take all those money in 11 different installments, is just not in just 10. It's almost a 10% increase there that you can take into your own advantage. So these will be some ways that you can play with that. Also, we don't see that often, that maybe, I don't know, you're a consultant, you're making a lot of money, and you don't want to take that, and you decided to take everything at the last year, because maybe the amount of money that you're receiving is not that big, and maybe in that year, you're just going to start your retirement. So there are a lot of strategies that you can implement, and that can help you there. So, well, we will say it like, continuing with these kind of cases, if you were moving to a particular state, like, for example, we are here in Florida, you were living in California or something like that, and you know that your taxes are way higher there. Maybe you can wait till your next year when you move to Florida, when you know that your taxes are going to be lower, or maybe you want to withdraw more money this year because next year your Medicare calculation is going to start, or maybe you just are going to get married next year with somebody that is really wealthy and your tax bracket this year will be lower. You can also go for something like that. So also, it doesn't have to, when we are talking about these kind of things, sometimes we are like just taking like what happened after, but we can also discuss about the strategies about, well, do the account owners can do something also? Yes, of course, they can go for some Roth conversions. When we go for Roth conversions, what we are doing is like we are moving money from that traditional IRA into a Roth IRA. Maybe your parents decide, maybe my kids are making a lot of money. If we're going to give them this money in the future, because maybe they are not going to use it, they will say, they will receive this money and their tax bracket is quite higher, and we don't want the IRS to receive more money than it should. So what you can do is to start what we call like a Roth conversion strategy. Will be something like, well, converting or transferring money from that traditional IRA to a Roth IRA and take the parents to a higher tax bracket. You can even ask the kids for paying for those taxes, because in a way they can give you like a gift to pay for those taxes there, and they're going to be receiving that money in a tax-free way. So you can also go for something like that. These are strategies that I will highly always recommend to go and hire a CFP. Always remember, a fee-only CFP. You want a fee-only because it's the one that is not receiving any fees or commissions from third parties. So be careful with that. So this is a strategy before, the accounts owners pass away. It could be a really smart strategy to implement. Also, there is something that could be sounding a little bit weird. You can also, if you want, you can increase the number of your beneficiaries. What I'm trying to say here is that maybe you want to leave some money to your kids, but also you said, what about my grandkids? Maybe your your daughter, your son is going to tell you, hey, Dad, I have, well, if something happens to you, yeah, I want you to know that I'm okay, but maybe my kids will need that money for their education or something like that. Instead of just naming your daughter and your son, maybe you can go and say, oh, this part of the money is going to go for my daughter and my son, and this other part of my money is going to go for my grandkids. So you're increasing the number of beneficiaries, and what you're doing is distributing more money in a different way. So when they withdraw that money, it doesn't have to go for them to a higher tax bracket. For example, the case of your daughter or your son, if they withdraw the whole money and they give it to the grandkids, it's going to take them to a higher tax bracket, and maybe they're already in a higher tax bracket. This is another strategy that's a really good one, but it sometimes can be a little bit controversial. Like, well, changing the weight of your beneficiaries. And what we're talking about, we love both our kids the same. We don't want to make any, I mean, I don't want to give more money to one, not to the other one, nothing like that. But maybe you are doing everything all right. You are working with CFP, and you have your Roth account, and you have your traditional account. And then you say, well, I'm going to distribute these two accounts equally to my beneficiaries. Maybe it will not be the best strategy if your beneficiaries are in different tax brackets. I don't know, one of them could be a consultant and he's making a lot of money, and the other one, I don't know, could be in whatever other profession that is not making that much money. Well, the one that is in a profession with a lower tax bracket will not be that beneficiated if he receives more money from the Roth account, because remember, Roth accounts are already tax-free accounts. But maybe if you give the whole money also to the one that is in a higher tax bracket, and you give all the traditional money that is going to be tax-deferred money, maybe that will push him to a higher tax bracket. And the thing here is not like I give more money to one of them, but the thing is here, like, you're giving more money to the IRS. So be careful with this. A CFP can help you also, I mean, to run the numbers for these kind of strategies. So some common mistakes that we would like to share. The first one, yes, remember the money has to be going out, and don't miss the deadlines here. This is really important. I mean, remember the date that it start to count is like this money has to be withdrawn after that 10 year. But remember, don't count the year of the deceased. You have to count the next year of that happens. I mean, rolling the money into run account. Remember, yeah, there are some people that sometimes they roll the money into their own IRA. No, remember to have a different inherited IRA for this money if you're not the spouse. Well, sometimes people they don't name a beneficiary, and that money has to go to probate and all those kind of things. It could be really, I mean, annoying. I mean, because you're going to pay a lot in taxes, and I mean, mainly with lawyers and things like that. So be careful with those lump sum. We already discussed about that. And remember, this is quite important. Remember to check the way the money was invested. If you know that you have to withdraw large amount of money, you don't want your whole money to be really risky assets, even though that maybe your parents were having that money in risky assets, but you know you're going to have to be withdrawing certain amount each year. And what about if the stock market plunge or something like that happens there? So be careful with these common mistakes there. And if you feel like, well, maybe you feel like, oh, there is a lot of information. Yes, there are a lot of rules there. And you want to check, maybe you want to have a session with us, a free session with us, so we can review your particular case. At Advice Financial, we can do that, and we work hourly and as a fee-only advisor. So thank you so much. I know it was a lot of information here.